Hey everybody, Brian here from quantlabs.net. Just wanted to show you the dashboard when you get access to this overview of futures option strategy for foundation course. Now, the historical reasoning behind this is to give you a focus on currency, metal, financial with pure fundamental analysis. What do I mean by that? Basically, when you look at the markets for the last 100 years, you'll notice that the markets moved a certain way with a lot of predictability up until probably in the 70s and 80s before electronic trading came into play. So starting in around the late 90s, maybe or sometime in the early 2000s, when electronic trading became more algorithmic trading, things got more complicated to analyze the previous generation of electronic trading, which complicated things. And here we are today. So this course really just offers an ability to look at how the markets used to work with predictability by knowing how the futures markets and the options market work, because one thing will impact something else. So for instance, if you have a metal, like let's say a copper on a futures market, the price of that's going to impact the performance of a fabricator of the metal, who will then turn around and use that for input product into their product, which will then be obviously impacting distribution and then eventually retailers. So that's what they call a value chain. This is one very small example of many, many examples that can affect the markets. And there's a lot of predictability between that, between the relationship between certain commodities, let's say, currencies between countries that only focus on certain commodities. So for instance, me being in Canada, we're pretty well oil-based. Our whole currency of the Canadian dollar is related around the price of the oil price and how oil is doing, because that's how our economy pretty well has been performing over the last few years. So that's just another example. Now, again, fundamental analysis is really important because it's really the study of supply and demand, where the economy is at, looking at forward-looking data, so on and so forth. And it's really important to understand how all that moves and how all that relationships are built into the markets. And again, you can do that with predictability. So that's what this course offers. On top of, when you look at all the asset classes with all the amount of data that's available in options, more data that you use, more predictability, more better your forecasting, and not only that, your upside is virtually unlimited. So you can do very, very well if you get the calls right in the options market. So that's why I've got this course. Now, one thing to understand is I've used source code for a combination of both C++ and Python, trying to reverse engineer what's available coming out of this UC Davis course, because it is built around a UC Davis course for options and futures trading. And that's pretty well how the whole thing pretty well works. So in a nutshell, this is all the content that's available. This has just been changed over with a design, so there's a few bugs here that needs to get cleaned up, but the course pretty well is the same. So here we have the different elements. You can tell there's 23 units or components within this course. It's pretty lengthy. And what it ranges from is understanding the history of the futures and options algorithms. As I said, there's an entire list of source code that's available that I provide, understanding all the different equations that are available, and including the course book. Lots of time's been spent there. And then, of course, we look at each and every module within the course itself. So this would be one example of what the course looks like, with a video, some source code, and some analysis, and of course the course itself. Sometimes we do a playback as well for that particular unit. Lots and lots of material here, and of course, as I said, we've got the video source code for both C++ and Python available for each module or unit, whatever you want to call it. So what are the topics, ranging from looking at treasury market, seeing what the Fed will do, looking at the euro dollar, understanding those relationships, understanding how the US dollar and euro move as examples. Of course, is more important examples, because this is an older course. So you want to understand how maybe the yen impacts something, or how the Chinese yuan impacts something, and so on and so forth. So again, you want to understand all the different methodologies of these concepts, demand and storage, understanding how price of storage impacts and how it affects the market, in temporal pricing theory, which is really important as well because that's how pricing relationships happen between each frequency of trading periods or trading sessions. Cost of carry model, just so everybody knows, cost of carry was one of the best performers last year as a model. Interest rate parity, I put up a video about how hot money is moving from region to region, and part of that is the interest rate differential that you can use where money's moved from one country to another country that has a higher interest rate. So there's multiple strategies that can come out of this course, and not just understanding that, but understanding the importance of how one type of asset class can impact another. Very important. Moving on, we've got the yield curve, which indicates how an economy is doing. Things like random walk theory, which is very critical. There is cyclical cycles in the market. The problem is trying to measure the magnitude of it and when it's actually going to happen. So the random walk theory sort of debunks all that. It just says the market's working random. Is this the random thing that you really can't predict cycles off of if you're trying to predict using so-called historical patterns or technical analysis with certain charting or whatever. Purchasing power parity is important to understand, which really is another way of saying inflation with a Big Mac. Hedging is really important because if you understand what asset class to buy into to hedge against potential downward movement in another class. So an example is gold. Gold is a great example. Like if you know your US dollar is going to go down and you want to protect that and the economy's going to go down, you're going to want to move your money into something like gold, where gold will either retain its value or actually go up. And that's again based around simple things of demand, supply and demand, when that's what's the underlying driving force of those prices. So it's really important to understand that on how the sentiment of certain economies are doing, where you can understand how one commodity can be used to counteract another commodity based upon money flow or an economy performance or overall how a market performance is doing. So really important. Of course, there's something called optimal hedging. Now, what optimal hedging gives you is really clear and really important, and where automation really comes into full fruition is when you do your analysis on the different types of potential portfolios out there. If you're doing portfolio analysis using things like value at risk or Markowitz portfolio theory, understanding what you want to hedge with and how to basically get your optimal hedge, which is obviously your optimal return. And that's what you always want, is where would you put your money for maximum return. Not just that, but you also want to understand how to use your portfolio to your advantage, to deploy your capital to different assets to again get maximum return in an up market or in a down market. Now again, of course, this continues along. Then we get into options on futures, which is basically there's the future market and then there's the options market, which is kind of built around futures, meaning options on futures, meaning storable commodities, because when you factor in that supply and demand, you can easily use that as an advantage of being either in futures market or an options market, specifically if the commodity is storable, meaning obviously oil or a fuel or an energy product or a metal product or an agricultural product or a financial product, meaning financial products that are storable, like there's only a limited number of treasury bonds out there or euro dollars, because when you look at the contract size of the futures market, the largest markets are usually euro dollar, treasury, and that's why these markets are so huge, is because of this concept of storable commodities. Really important because, again, remember that these instruments have been used way before electronic trading has come into play. It's also used as a safety haven. On top of it's used as a confidence, a sentiment for confidence of how the markets are performing. And Forget all this, the retail traders and that poor way of looking at the markets. You want to know how the professionals are looking at the markets. And this is how they do it. They look at this stuff and they use this stuff to indicate to themselves and to their firms, to their bosses, on how they want to invest their capital based around these commodities or other instruments. All based upon how, again, the performance of the markets are, how other countries are doing, and how and where they want to allow their investments to flow into. Pensions funds do this, hedge funds do this, investment banks do this, and that's what I mean, institutional, professional traders. That's what these guys do. Okay, moving on, additional options concepts with comparison to futures. So it's all about maximum return. Sometimes you may get a better return on the futures market if you buy into an options with a future, but there's limitations with that versus an options on an oil contract. Understanding those differences will give you when to do it, under what condition, using all these fundamental analysis principles, and being able to probably analyze it. Again, no human could possibly do this. That's why humans only watch one type of asset, maybe oil, maybe gold, and maybe one type of currency, because that's all humans can do. But imagine when you take all of this capability and put it into automation and you let some kind of script run against all of this analysis, you are way ahead of the market, and you're way ahead of the retail trader as well in a wide scale interpretation of how the markets are moving across all major asset classes and instruments. Okay, so here we goes into some examples, and again there's some concepts here called put parity, which is important to understand the balancing of the markets and what also again drives that supply and demand in the different commodities and futures and option instruments that we've talked about. And then again, Black-Scholes. One of the problems that I do notice with all these mathematicians where they go off on their little PhD expeditions is they always forget about the core principles of how the Black-Scholes can be used and why it was developed. You know, it's a good measuring stick. It's of how volatility is measured. And unfortunately, a lot of these traders out there are always slaves to what they call slaves to volatility. And the lazy ones are the ones that are slaves to VIX. VIX is not forward-looking. All of these concepts are forward-looking, and you need to understand that. These are today and forward-looking. They don't care what's happened in the past. So Black-Scholes is very good at measuring, you know, what would your premium should be and how much should you be buying and what kind of premium and how do you value it. That's where the Black-Scholes comes into play on top of when it comes to playing in the world of options. So Black-Scholes is very, very critical and has been used since the 70s. Again, we've talked about hedging, how to hedge particular options as well to balance your portfolio and get maximum balance. Speaking of all this, there's a very good analysis on maximizing your utility and measuring against your risk, understanding your goal, which will greatly enhance your portfolio, using something like Markowitz, which is pretty powerful in itself to understand the position sizing and the position weighting in your portfolio. So then finally, the last one is just, again, as I said earlier, to understand when to put an option on versus to put on a future and how to analyze the markets. This is so critical to really to be a true trader in the currency market, to be a true trader in the futures and or the options market, where you, like I said, options markets where you get maximum potential return. And then of course, if you decide to play in the stock market, but I will tell you this, which is glad I'm bringing this up to the last point, is that the markets right now, looking at my Bloomberg analysis with Bloomberg, what I'm finding very few of the professional traders are actually buying up individual stocks. They're actually using ETFs and buying up sectors, and that's where the ETFs come into play. And they use ETFs because it's very low transaction fees to move in and out. And people have asked me what would they do with their money. I would just stick with ETFs and stick with the big players like BlackRock and Vanguard, who are the big players in this market. And when you look at a chart of the size of the markets that Vanguard has, it just dominates the entire ETF market. And the performance is pretty good as well. And what drives that is because they're an HFT shop and their analysis is quant based, and that's why they own and dominate the market. Just as an example of what ETFs do. And why do I say that? Because part of this course will also look at stock market indices, but they don't go farther into looking at things like individual stock. Doesn't cover that. The amateurs pretty well that get minimal returns are the ones playing in the markets, the stock markets, and specifically the US. There's times where probably right now where emerging markets, those stock markets are killing off the performance of the US markets. And sometimes obviously the US markets do well as well, but there's emerging markets that are doing well as well. So to make your life easier and to minimize your risk, you might as well just get an ETF. But again, this course will help you understand where to put your market sector if you want to also do a future versus an option or play in the world of currencies through this. This can impact pretty well all your trading. It's a very powerful way to learn how to use the fundamentals of the market, specifically in the world of futures and options, and it impacts everything else around you if it's in currencies like Forex or even stocks. And because you're also looking at treasury bond, when the markets get really bad, you also have fixed income if you have the capital play in those markets. So that's pretty well the length of the course. It's approximately 26 hours. I believe it's probably a lot longer than that with the playbacks and the source code that comes with this. Okay, so I just want you to be aware of that. Very, very powerful way to learn about trading, and the key is to help build your foundation properly in order to be able to build better forecasting and make it a lot more predictable. Hopefully this will help you out. Hopefully this course will help you out. And of course, my name is Brian, this dude here at the bottom, going through everything about this. And this will never change in the market. So this is one of those timeless pieces of information that you should own and consume. Over and out.